Let's move on to the third module for estimating the cost of equity, which are the Modigliani and Miller true formulas. There are two scenarios resulting in the two different formulas. One is where no tax exists, and the other is where tax exists. Both formulas used in estimating the cost of equity resulting from the two different scenarios show how the cost of equity changes with financial leverage or financial gearing. Let us look at the first formula, which is under the scenario where no tax exists. The formula is as shown on screen. The formula shows that as the company uses more debt, the cost of equity rises, and this is because of two major factors. The first one is that debt increases financial risk, and the second is that shareholders demand higher returns to compensate this increase in financial risk. So this is how it works. When an organization takes on debt as a source of finance, debt holders are paid first before shareholders are paid. And the shareholders also face higher risk of volatility in earnings and bankruptcy. So considering these factors, shareholders should require a higher return. The second formula is under the scenario in which we consider the tax effects. For this one, the formula is as displayed on screen, and the incorporation of the tax element is what differentiates it from the first formula. You need to take note that the reason why we incorporate tax into the calculation is that there is a tax shield due to the interest on debt that is tax deductible. And it should be taken note that due to this tax shield, the increase in the cost of equity will be less steep. So under both formulas, the mechanism for calculating the cost of equity is as follows. First, identify the variables and then estimate the cost of equity by applying the formula. Let us look at an illustrative example applying this model for estimating the cost of equity. From the scenario displayed on screen, we are required to estimate the cost of equity based on information provided in the scenario. The first step is to define variables. So we are given our ungeared cost of equity at 10% and the cost of debt at 5%, tax at 30%. Based on the financial gearing ratio, the market value of debt is 40 and the market value of equity is 60. If you apply the formula, we get 12.33%. So in summary, we have covered the three models used to estimate the cost of equity, which are the capital asset pricing model, the dividend valuation model, and the Modigliani and Miller true formulas. Let's move on to the estimation of the cost of debt, debt finance being the other primary source of finance. There are three scenarios to put under consideration when estimating the cost of debt. The first scenario is where the debt is redeemable. Second is where the debt is irredeemable. And third is the case of convertible bonds. Let us look at each of these in detail.